Today, global financial markets are sending a very unusual signal. On the surface, the news looks positive. Inflation in the United States is cooling faster than expected. Consumer prices are no longer rising at the aggressive pace we saw over the past 2 years. For households, that sounds like relief. For investors, it should mean optimism. But instead of rallying strongly, stock markets are hesitating. Some sectors are falling, others are quietly gaining strength. And this divergence is becoming the most important financial story right now. Let's break down what is really happening. The latest inflation data showed that price growth slowed more than economists predicted. Energy costs stabilized, supply chains continue to normalize. Wage growth, while still solid, is no longer accelerating at the same rate. Normally, this kind of data fuels strong rallies in equities because it increases the probability that the Federal Reserve may reduce interest rates later this year. Lower interest rates typically make borrowing cheaper. Companies can expand more easily, consumers spend more, and investors tend to move capital into risk assets like stocks. But here is the twist. Markets did not react with full enthusiasm. Major indices showed volatility instead of a clean breakout. Technology stocks, especially those connected to artificial intelligence and high growth expectations, experienced renewed pressure. Why? Because markets are now shifting their focus from inflation to earnings. For the past year, much of the stock market's growth was concentrated in a small group of mega-cap technology companies. These firms benefited from the AI boom, massive capital inflows, and investor excitement around automation, cloud computing, and semiconductor demand. Valuations expanded aggressively. In many cases, stock prices rose much faster than actual earnings growth. Now investors are asking a harder question: can profits justify these prices? When inflation was the dominant concern, markets traded on macro expectations. Now the focus is returning to fundamentals: revenue growth, margins, cash flow, competitive advantage, and that shift is creating friction. At the same time, bond markets are reacting differently. Treasury yields have eased slightly as traders price in the possibility of future rate cuts. This creates a complex environment. Lower yields typically support stocks, especially growth companies. But if yields fall because investors expect slower economic expansion, that becomes a warning sign instead of a positive catalyst. This is the balancing act happening right now. Another important development is sector rotation. Defensive industries such as utilities, healthcare, and consumer staples have begun to outperform high-beta growth stocks. This indicates that institutional investors may be reducing risk exposure. They are not panicking, but they are repositioning. When capital rotates defensively during a period of cooling inflation, it suggests that investors are more concerned about earnings durability than about central bank policy alone. We're also seeing signs of caution in global markets outside the United States. European equities have struggled with slower manufacturing data. Some Asian markets are dealing with weaker export activity. Emerging markets face pressure from a relatively strong US dollar, which tightens global liquidity conditions. Currency markets reflect this caution. The dollar has held firm, signaling that global investors still view the US as relatively stable compared to other regions. When the dollar strengthens during uncertainty, it often indicates risk aversion rather than risk appetite. Gold has also shown resilience. While not exploding higher, it remains supported as investors hedge against macro unpredictability. When you see bonds stabilizing, gold holding firm, and equities showing selective weakness, it tells you one thing: markets are uncertain, not euphoric. And uncertainty is the dominant theme right now. There is another layer to this story: the concentration risk in equity indices. For the past year, market performance was heavily dependent on a handful of large technology companies. If those companies pause or correct, the entire index feels heavier even if smaller sectors are performing adequately. This creates a fragile structure. It means that broad index performance may not fully represent what is happening beneath the surface. Some industries are quietly recovering, others are consolidating, but the headline numbers look volatile because leadership is narrow. Investors are beginning to recognize this imbalance. Another factor influencing sentiment is corporate guidance. During recent earnings calls, executives have been more cautious about forward outlooks. They are acknowledging higher borrowing costs compared to pre-2022 levels. They are discussing margin pressures from labor and input costs. They are more conservative about expansion plans. Even though inflation is slowing, the cost environment is still elevated compared to historical norms. Companies must adapt to structurally higher financing costs than during the ultra-low rate era. That adjustment takes time. So what does this mean overall? It means we are entering a transitional phase. The market is moving from a macro-driven rally, powered by rate expectations and liquidity, towards a fundamentals-driven environment where selectivity matters. In simple terms, easy money narratives are fading. Profit quality and balance sheet strength are becoming more important. Volatility during these transitions is normal. Markets rarely move in straight lines. When leadership shifts and valuation assumptions are challenged, price action becomes uneven. For long-term investors, this environment is not necessarily negative. It often creates opportunities in sectors that were previously ignored. When capital rotates, it doesn't disappear, it reallocates. However, short-term traders may experience increased swings. Headlines about inflation improvements may lift futures temporarily, while earnings concerns bring pressure the next day. The key takeaway is that markets are no longer trading on a single dominant story. Inflation, interest rates, corporate profits, global growth, currency strength, and sector rotation are all interacting simultaneously. This complexity is why we are seeing mixed signals rather than clear trends. Looking ahead, the next catalysts will likely include further inflation reports, central bank commentary, and updated corporate earnings guidance. If earnings remain resilient while inflation continues to cool, markets could regain upward momentum. But if profit growth disappoints, valuation compression may continue in high multiple sectors. The era of broad, effortless rallies may be behind us for now. Instead, we are entering a phase that rewards discipline, diversification, and analysis. Markets are recalibrating. And recalibration is not collapse, it is repricing. It is capital searching for equilibrium between optimism and realism. In financial history, these transition periods often define the next cycle. They test assumptions, they shift leadership, they create new narratives. Right now, the biggest financial story is not panic, it is adjustment. Investors are adjusting to a world where inflation is easing but not gone, where interest rates may fall but not immediately, where growth continues but at a moderated pace. And in that adjustment, the market is revealing something important. Confidence is no longer blind, it is conditional. Understanding that distinction may be the most valuable insight in today's financial landscape, because when markets move from excitement to evaluation, the rules change, and those who recognize the shift early are usually the ones who navigate it best.